Well, good morning, everybody. And what I want to do today is talk about current liabilities management. And if you remember from 3:30, current liabilities appears on the balance sheet, right? Under the liability side, it's short-term liabilities. Remember that? So I want to talk about that a little bit. And you can see we're going to talk about accounts payable and what's the effect of a stretching accounts payable, and we're going to talk about interest rates. This is a big chapter, so I'll have to break this up. And we'll talk about commercial paper. And commercial paper is when one company lends short-term money to another company, like between 30 and 270 days, something like that. Okay, so there's a couple terms here that we have to know, right? Spontaneous liabilities and unsecured short-term financing. So spontaneous liabilities are financing that arises from your normal course of business. It's like when you run your house, right? You got your normal expenses for your house. So you have spontaneous liabilities that come up every month, right? I got to pay my electric bill. I got to get oil. So in this case, for a business, there are accounts payable and accruals, right? So my accounts payable would be my LIPA bill and getting oil and paying my HOA fee for my condo. Okay, so unsecured short-term financing is short-term financing obtained without pledging any assets, right? It's unsecured. So it would kind of be like getting an unsecured loan. So most when you get a mortgage, right, the house it's secured because they'll take the house from you. All right, so there's a little statement here that's kind of important, and I'm gonna highlight that in red. And I'll tell you why in a minute. All right, so the firm should take advantage of these interest-free sources of unsecured short-term financing whenever possible. Okay, so interest-free. Those interesting words. Interest-free when I go to Home Depot. I had to buy a dryer recently, right? So they give you 1 year interest-free financing, and you might as well. Why would you want to shell out your money to them when you could pay it interest-free over a year? Instead of giving them $800 or whatever, you can invest that money in your own stuff, on your own investments, and then you dribble money to them. And I do that with everything, and especially the big thing is a car, right? If you can get interest-free financing on a car, why would you give them $30,000 all in one shot when you could pay them $400 a month interest-free? The other thing is, you should never want to get money back from the IRS, because if you get money back, that means you loan them money interest-free. You always want to pay the IRS, because then they give you an interest-free loan. Up to a point, you probably don't want to owe them too much, but you should. I know someone who basically would get back $8,000 a year, and that person was very happy to do that. And I said, you could be investing that money, and even if you made 10%, you would pick up $900 on it. But be that as it may, I think you get the point. All right, so accounts payable are the major source of unsecured short-term financing for business firms. So, they result from transactions in which a merchandise is purchased but no formal note is signed. And, and you got a liability, right? So there's two parts to the payment period, right? The time from the purchase of the raw materials until the firm mails the payment, and the payment flow time, the time it takes for the firm to, when they get the money, to clear the bank. And I do that all the time when I pay my bills online, right? And there's like a 30-day float. I pay it, and then there's a float time when it clears my checking account. I'll pay it on the last day online, and then it takes 3 days for my checking account to see it. Anyway, all right, I gotta have a sip of coffee. All right, so so accounts payable management again is managed by the firm of the time. Management by the firm of the time that elapses between its purchase and its mailing payment. So that's like me, as I just said. When the seller of the goods charges no interest, this again is important, right? And offers no discount to the buyer for early payment, the buyer's goal is to pay as slowly as possible, which is what I just told you what I do, without damaging your credit rating. So this is, you're making use of your an interest-free loan, which again is what I said, from the supplier, and will not damage your credit rating. So here's an example of that. Right? Here's an example of Brown-Forman Corporation. They make Jack Daniels. I don't drink Jack Daniels, but I like Johnny Walker. Anyway, all right, whatever. So, here's some numbers associated with them, and, you can go over these. They have revenue of $3.8 billion. They have costs of $1.8 billion, and and then their accounts payable, which money they have to shell out, right, is for almost $500 million, $468 million. All right, so you can go through these numbers, and they have this thing called this cash conversion cycle. It was 87 days, and I believe the cash conversion cycle was covered in chapter 15, if I'm not mistaken, right? So here's the whole calculation from those previous numbers for the cash conversion cycle, and you should review earlier stuff if you have to. So here's the inventory, and here's the accounts receivable. Remember, accounts receivable is what you have to pay out, right? And you subtract off the accounts payable, and you've got $0.92 billion, almost $1 billion invested, right? All right, so they go through different scenarios. Now, if they were to increase its average payment period by 5 days, its account payable would increase by $17.5 million. As a result, their cash conversion cycle would decrease by 5 days, and the firm would reduce its investment by $17.5 million. So, an important point is if this action did not damage their credit rating, it would be in the company's best interest. All right, so there's things called credit terms, right? There's things called credit terms here. The credit terms that a firm is offering by its suppliers enable it to delay payments for its purchases. So, Lawrence Industries, operator of a small chain of video stores, purchased $1,000 worth of merchandise on February 27th from a supplier, extending terms of 210 net 30 end of month. If the firm takes the cash discount, it must pay $980. So here's what they're saying with all that. By March 10th, right? All right, so they're saying if you pay within a 10-day period, right? You bought it the 27th. March 10th is 10 days away. See the 10 there? They'll give you a 2% discount. So 2% of $1,000 is $20, right? So if you pay early, you get you only have to pay $980. If you don't, you got to pay $1,000 by the end of the month, end of March, right? All right. So again, there were examples of that in the book, and I think that's in earlier chapters. All right. So the cost of giving up the cash discount is the implied rate of interest paid to delay payment of an account payable for an additional number of days, right? So if you give up the cash discount. All right, so here's a good example of these payment options. Here's the $1,000 purchase. The credit period begins here, right? So here, if you pay by March 10th, right, you only pay $980. If you don't, you got to pay $1,000 on March 30th. And the cost of those additional 20 days, of course, is the $20, right? All right. So to calculate the cost of giving up the cash discount, the true purchase price must be viewed as the discounted cost, which is $9.80. And basically, if it takes 20 additional days to pay by paying on day 30 rather than on day 10, they have to pay this an additional $20 in interest on the $9.80, right? So therefore, the interest rate for this transaction is going to be 2.04%, which is 20 divided by $980. Now that 2.04% is for a 20-day loan. So if you annualize that, right, you got to keep in mind that that's not for the year, right? That's 20 days, right? If you annualize that, here's how you do the calculation. To calculate an annualized interest rate, you put the number you had in there times 365 of the number of days that payment can be delayed, right? So this is the equation, which is in a blue box, so it's important. So I would keep my eye on that, right? And here's the approximate equation. This is an approximate equation of the previous one, all right? So you can clearly see here that the actual interest rate you're going to pay by giving up the cash discount annually is 37.24%, or approximately, if you use the approximate equation, 36.5%. So you don't want to do that. If you get a discount, take it, right? Alrighty, we'll stop there, and I will pick up on part 2. Have a good day, everybody.